Hi, good afternoon. My name is David Duffy. I'm the co-chair of the Thompson Coburn Business Litigation Practice Group. I'm really glad you all have chosen to join us for our presentation today on policyholder insurance trends for 2022. If you're joining us after having attended the first in this series of business litigation presentations, which was 10 Ways to Avoid Cyber and Privacy Lawsuits by Jim Shreve, Luke Sosnicki, and Drew Moore, I'm glad you could join us. If you didn't have the opportunity to attend that session, I hope you can attend one of the upcoming sessions in this business litigation series, which we'll talk more about at the end if there's time. Thank you again for attending today's webinar. Before we get going, I wanted to cover a few housekeeping items. If you have any questions during this webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these questions during the webcast, but if a fuller answer is needed or we run out of time today, it will be answered later via email. A copy of today's slide deck is available in the resource widget. We encourage you to download any resources or links that you may find useful. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. This webinar is CLE accredited in California, Illinois, and Texas for 1 hour of general credit. Missouri, it's approved for 1.2 hours of general credit. And New York, transitional and non-transitional, for 1 hour of areas of professional practice. We award CLE based on attendance for the entire 60 minutes. Due to changes in jurisdictional requirements, you will notice that we are no longer using automated pop-up attendance checks. As required, we will display secret words in 2 multiple choice polls during this webinar. You will be required to select today's secret word from a multiple choice list. Please respond to these 2 polls to demonstrate your continued engagement and to earn your full CLE credit. We value your opinions and appreciate your participation. Now let me have the pleasure of introducing your presenters today. In addition to myself, the 2 presenters who will be doing most of the talking today, the first is Matt Darrough. Matt is the chair of Thompson Coburn's Insurance Practice Subgroup in our Business Litigation Practice Group. He's a partner in our St. Louis office. He's also a fellow of the American College of Coverage Counsel. Unsurprisingly, Matt guides policyholders and insurance professionals on everything from placement of coverage to questions regarding coverage and coverage-related litigation. Also joining us from our newly adopted Dallas office is John Atkins. John is a counsel in our Dallas office, and he himself is a former insurance professional. He was a policy analyst for the Oregon Insurance Division, and we're glad that he's joined Thompson Coburn. His practice focuses upon insurance and indemnity litigation and counseling. Matt, can you pull up the slide on the agenda, please? What are we going to cover for you today? We have a series of areas about our 2022 policyholder information. What we are going to break this into is in 5 separate parts. The first, we're going to talk about insuring cyber risks. Well, undoubtedly one of the most important areas of insurance issues facing your businesses today. Relatedly, we will talk about social engineering as a unique area of cyber-related issues and how the insurance industry is addressing social engineering. Then we'll shift and we'll move to pandemic impacts on the insurance claims and the insurance market. We'll talk a little bit about new technologies and insurance, and then we'll move into just some thoughts and general understanding of the current insurance market. With that, I'm going to turn it over to Matt Darrough to kick us off with cyber risk coverage issues.
Thanks, Dave, and thanks everyone for joining us. I think everyone has some concept of cyber risk, but I thought I'd start out by just explain how we view cyber risk in the insurance industry, and that's really both a number of internal risk relating to cyber issues and external threats as well. So it could take the form of, accidentally disclosing private information on customers, patients, employees, or others. This could be something as simple as, an employee leaving a laptop that's accessible on the train or something like that with a lot of private information in it. The external threat actors may be hacking, accessing, breaching into your system to try to monetize something or just to cause problems. It could be something which is very prevalent today. You probably see it in the news. Maybe you've experienced it with a ransomware attack where the perpetrators install ransomware and essentially hold your systems hostage unless you pay a certain sum. There are a variety of exposures that would fall in this category and a number of different types of losses and liabilities that can result depending on the nature of the situation. There may be what we refer to as first-party expenses and are covered under first-party policies, which are amounts of loss that you would incur or expenses you would pay out, whether it be to attorneys, to ensure compliance with privacy laws, paying a forensic firm to figure out what the heck is going on and how to fix it, business interruption losses, or paying that ransom. And then there are a number of third-party suits that create potential for liability that require a defense and potentially indemnification if you lose, whether those claims come from partners whose system, maybe the virus spread to yours and impact it, the loss of their information you're holding, or claims by individuals who contend that you have breached the law or been negligent in causing their private information to be accessible. So, with that said, are you susceptible to this kind of risk? And of course, we all are. There's some recognition that it's so prevalent today that everyone has exposures, but everyone is every day more dependent on systems now with information that's stored digitally. You may be heavily invested in your IT for protection, but you have to be correct 100% of the time. The cyber criminals only need to be correct once for you to have a situation. And there are new and developing threats every day in this area. Human error is a near certainty, so no company is immune. Historically, a lot of folks thought that the exposure was to large companies. You would see in the news Target, Home Depot, Sony, Yahoo, who were subject to these situations, hacking, breaches, ransomware. But today, the criminals are really focusing on a lot of small and medium-sized companies as well. They found it more difficult to deal with some of the larger companies that beefed up their cybersecurity. They're going after everybody. In fact, the amount of phishing situations to try to enter systems is the majority of them are small and mid-sized companies today. So how can you transfer this kind of risk? Of course, every effort should be made to mitigate against this kind of risk, but you're not going to be able to eliminate it. So there's really two routes, and they can be belt and suspenders to transfer risk to others. One would be through indemnification provisions in your contracts, such as with vendors and service providers. This is really just shifting the risk contractually through the indemnification provision. The second is insurance. And insurance really is just a contract of indemnity with an insurer on the other end. Now this, of course, you can purchase your own insurance, and we're going to talk a lot about what those options are. But you can also have insurance requirements in those same contracts that provide indemnification those requirements can state that the vendor, the provider, whoever your counterparty is going to maintain certain types of insurance and include your business as an additional insured, so you can access those policies and benefit from that coverage if you have a loss situation or a liability that falls within the ambit of that coverage. One thing I do want to mention when you're looking at your insurance requirements is enforcing those provisions. I think it happens very often that people put them in there. The other side doesn't understand them. It's oftentimes the party requiring them doesn't understand them. And frankly, sometimes the brokers who issue the certificates that you see all the time don't truly understand them, or no one knows how to read those certificates properly. I would always advise to put in the provisions that you have a right to see the policy, or at least particular provisions that are important to you, and that you follow up and make sure that the coverage that you are requiring is actually in place to pay out when there is a situation. Now, a lot of people believe that they can find coverage for the types of cyber risk that we talked about in some of the more traditional policies. And I want to be clear before I talk about some of the problems with finding this coverage in traditional policies that I'm not saying you should not look for coverage in these types of policies when you have an incident. Even if you have a cyber policy, you could have coverage under other policies as well, and all policies could potentially respond to your benefit. So I would look under all of them. We found coverage for intruders hacking into systems under property policies. We found coverage for theft of certain things through intrusion in systems under crime policies. We found liability coverage for suits relating to disclosure of private information under commercial general liability policies. And we've even made successful claims under the entity coverage of directors and officers liability or management liability policies for all kinds of suits, because they have a very broad insuring agreement that is a broad grant of coverage. And so if the exclusions are not robust enough to take out this kind of risk, you may be able to access that kind of policy. But none of these traditional forms of policy are really designed to sort of capture all the risk and all the damages, losses, and liabilities that I started with in describing the cyber risk that is involved. The liability policies, of course, they can provide defense and indemnity. They're not going to afford you any of this first-party coverage, which I mentioned, which is to pay you for the losses you suffer as far as trying to determine if you have a privacy situation, paying out for notices to satisfy that privacy situation, your business interruption, satisfying a ransom, that kind of thing. They just don't provide coverage for you. They would potentially provide defense and indemnity, but there are problems with each of them as well. With the commercial general liability, it's definitely, these don't raise usually bodily injury claims, and there's no tangible property involved. There is a component of those policies for personal and advertising injury, but it is defined. It's a bunch of enumerated offenses that are defined, and there's a number of exclusions in those standard policies as well that can create problems. With your errors and omissions or professional liability coverage, it really has to be something arising out of your errors and omission in providing someone else professional services, and it certainly may not fall within there. And as I mentioned, the D&O policies are just full of exclusions, and a lot of them are going to take this out. With your traditional first-party coverages, which are your crime and your property, those aren't going to provide you the liability protection, and it may not be a insured peril under your property coverage, and frankly, it may not be insured property. If something happens where there's a fire that burns down your computer systems, that's covered. If someone intrudes into those systems and steals data or information, that may not be covered. There are instances where it could be. It depends how it's written. With your crime policies, they are designed to pay out usually the theft from different factors and some other losses too that we're not talking about, but of tangible property, money, securities, and it may not fall within the scope of those coverage grants. Now, with respect to cyber risk insurance, it's been around for quite some time, more than 2 decades now. Traditionally, or historically, it was quite difficult to underwrite. There weren't a lot of players offering it. There was a lack of actuarial data for their purposes. It was changing and evolving quickly. It was hard to evaluate what kind of risk a particular insured systems presented, but is growing rapidly in recent years, as you may well know. There are a number of factors for that, some of them rather obvious, but the enactment of the privacy breach notice laws and their development and enforcement, an accelerated reliance on electronic information, and frankly the pandemic has only elevated and accelerated that reliance on electronic information for both storage and communications. All the high-profile hackings and ransom attacks that hit the news regularly. And you see a lot of in the news about state actors or quasi-state actors that are involved as well. There are now billions of dollars in premium per year relating to cyber insurance. It could be up to $10 billion in the near future. Some speculate that when everything is said and done and everyone's maintaining this coverage, the premiums each year will ultimately exceed $80 billion. There are now a number of insurers offering these coverages in both the U.S. and the foreign markets. A lot of it is written out of foreign markets, including the London market and the Lloyd's slips that are issuing this kind of coverage. So what can a cyber policy cover? We've touched on some of it. It's easiest to break it down into the 2 types that I've talked about already, the first-party coverages and the third-party coverages. And the easiest way to understand this is not all policies may offer all this coverage. Some throw certain of the coverages in, some are comprehensive, some you kind of pick and choose, okay? But these are usually the typical offerings in these policies. With respect to the first-party coverages, there are the legal expenses associated with reviewing and determining if your business has responsibility to provide notice under the privacy breach law, and then assisting with satisfaction of those regulations and proper notices and so forth if it is required. The forensic costs can be very, very expensive, and this is to pay teams to come in, identify the nature of the situation, the breach, the way they access to remediate, restore your systems. These policies will not pay typically to improve your systems if you're installing new technologies that go beyond what you had previously, but to restore your system and bring it back to where it was before the breach, to kick out the perpetrators out of your system. That's the forensic cost that will cover. If you do have to have a privacy situation with private individuals' information and notices required, these policies will pay out to satisfy the cost. Depending on how many individuals are involved, it could be expensive. And sometimes to try to head off litigation and help out these people, they will offer credit monitoring. And so this coverage can pay to satisfy that credit monitoring to people who are impacted by a breach. Importantly, there is business interruption. This can go with all kinds of breaches and problems associated with cyber risk that could take down your system and cause an interruption in your business relating to extra expense and loss of revenues because of the downtime. I often see kind of hand-in-hand situations with what I call the coverage for cyber extortion, which is what we talked about before, like ransomware attacks where someone's holding your system hostage. A lot of times the carriers, through the council and other other individuals that they retain to help with this situation will actually negotiate with the criminals on that ransom and try to negotiate it down before something is paid out. That can take an extended period of time. We've had situations where it was taking so long for them to try to figure out the ransom that we had to press the fact that they're going to have to pay the interruption that is being caused in the situation. It's better just to pay out the ransom. So these kind of coverages can go hand in hand if you have all of them. From a third-party standpoint, this is your defense and your indemnification for liability for third parties that bring claims or suits against you. They really kind of fall into three categories. The first one is network security situation. This would be if you transmit malware viruses to other people who would pursue you, you lose their kind of information that you're holding. There could be any number of third-party claims in this category. The privacy liability is usually brought by individuals or a group of individuals or class of individuals that are claiming you improperly disclosed their private information. And then third, from a regulatory standpoint, federal or state regulators could pursue claims or could pursue actions against your business relating to violations with respect to the privacy laws, and these policies can pay out to defend those and pay off fines and penalties. So one of the things that I want to mention is these policies are really a labyrinth of insuring agreements, definitions, conditions, exclusions, and endorsements. And they're, you know, the devil's in the details on a lot of these, the interplay of these provisions. And there's all kinds of problematic provisions that end up in these policies depending on who issues them, because they are not all written the same way. Some of the exclusions you need to be wary of, where carriers have gone too far and essentially gutted what the purpose of this policy is supposed to be, are any exclusions that will try to remove coverage for negligent acts by your business or employees of your business, because these are supposed to cover situations even if they arise out of negligence. So if there are exclusions added for failure to continuously implement procedures and risk controls identified in your application, they should be avoided. Exclusions for failure to take reasonable steps to use, design, maintain, upgrade your security, that's problematic. Exclusions for errors in designs, mechanical failure, loss caused by employees, errors in programming, utility failures, all those aren't necessarily in all these policies, but we've seen them in some, and they're problematic. Another issue to be wary of is how the policy defines the covered systems. Is it limited to just your computer system or ancillary systems that are involved with your business, such as third-party networks, you know, what vendors are doing, cloud usage? Those can impact your business as well, whether it be an interruption or a problem related to those. And so the scope of the coverage as to what is involved is important. One of the other issues is you'll see exclusions for war, foreign enemies, terrorism, etc. This gets pretty murky. I don't know if they can be written out of all the policies, but we certainly push back on those. If you have regulatory coverage, which is one of the items I talked about, it's important to see if that's just defense coverage or if it will actually satisfy fines and penalties. With shareholder derivative suits, you could face suits, or the directors, officers, etc., could have a suit based on problems what the company has experienced because of the failure to prevent one of these situations. It may be difficult to cover it on a cyber policy. Then you have to look at how it would work in conjunction with your directors and officers coverage, and if there would be an exclusion in that D&O policy for this kind of situation. So how do you protect your business? I think it's important to understand what I mentioned is not all these policies are the same. They're not uniform. You can't just compare the quotes because the forms are not equal. Even when you are placing coverage for general liability or property, there's some breakdown where you're working with your broker to make sure certain terms are in there or certain provisions are in there, in addition to looking at the limits they're offering and the premium they're charging and where they set a retention or a deductible. But here it is important to understand the base forms are not even all the same, because each carrier has prepared its own form. They may cover a lot of the same categories facially that I identified, but some coverages may be much broader than others depending on how they're written, what kind of exclusions are included, and so forth. So, of course, work with your broker on these, but you can also work with an attorney to assess the various offerings. We're glad to jump in as coverage counsel, or any coverage counsel would be, and they're often needed when there are disputes or litigation after the fact. But a little preventive medicine can go a long way to make sure the coverage you're putting in place matches your expectation, your understanding, and these forms can be negotiated with carriers either through a modification of the form or through an endorsement, and attorneys can work with you and with your broker to try to achieve those modifications. With that said, we have reached our first secret word. Our first secret word is blue. You please select the correct word from the list below. Okay, with that said, we are going to move on. I'm going to turn it over to John to talk about social engineering.
All right, thanks, Matt, and thanks, David. So I wanted to start by noting something that Matt talked about, which was ransomware, or sometimes called cyber extortion coverage, because it's a great example of something that's also a significant issue associated with social engineering. Social engineering is also one way that you might end up subject to a ransomware or a cyber extortion attack. And that's that you really need to know and have a good sense of what your policy says before the loss, so that you understand what you can do and what you ought to do or are able to do once the loss actually occurs. However good your lawyer is and however good we are, we can't change the text of your policy after a loss has already happened. A good example with respect to ransomware or ransomware attacks or cyber extortion attacks, is that there are different provisions written into different policies covering that risk that determine whether or not you can, while still obtaining coverage for the payment, make the decision to make the payment on your own, or whether you require written consent from the insurer in order to make the payment. And that matters depending upon your business. If you are a major hospital or something and the ransom attack affects a bunch of medical data that you need in order to treat patients, you may not have the time to secure written consent from your insurance company. And so understanding the kinds of situations you might find yourself in, having a plan for that is obviously important. And I'm sure earlier today, if you were in the previous presentation, you heard some advice about how to be prepared. But part of preparedness is making sure that your policy fits what you're likely to face. And can you move us forward, Matt?
Oh, sure. Thank you.
So another example that has the same factors as that, or the same issues as that, is social engineering. The typical social engineering case is basically just an email theft by impersonation scheme, and it, depending on the type of scheme, it may fall within several different kinds of coverage, but the two principal ones are either your cyber policy or your crime policy. One thing to understand about how cyber came about and how it's altered the market is that cyber, unlike a lot of other types of insurance product, isn't a pure first-party or pure third-party type insurance. It's not just liability insurance. Cyber insurance will cover certain types of liability risk. It's not just a first-party insurance, but it will cover certain first-party losses. Some cyber policies will cover you for the cost of recovering or reconstructing data. Some will cover you for certain amounts of business interruption. So it has features of both, but what that means from the insurer's perspective is that they don't want to insure you for a risk that they think should be insured in a cyber policy in one of their other policies, which means that the commercial general liability policy and the employment practices liability policy and your garden variety property policy and even your crime policy are likely to have exclusions that are designed to carve out cyber with the expectation that you will have separate cyber coverage. However, if you're not careful and you don't plan carefully and analyze your various policies against one another, at the time you bind them, you may find at the time that you suffer a loss that there is a gap between your cyber policy and your crime policy. And that gap can exist in the following sort of two different examples. One of the archetypal examples of social engineering is somebody hacks into your system, introduces some malicious code, takes over the email account of an executive at your business, and sends an email to somebody who has the ability to transmit wiring instructions or money, and gives that person, sends an email commanding that person to wire a bunch of money or to provide wiring instructions to or data to send money to somebody who they claim is a vendor or something else. The payment then occurs. Of course, the payment was to a thief. Are you covered? Well, that situation involves the modification of your computer system, and there's some case law in a lot of cyber policies that is a covered loss under a cyber policy. But let's say it's exactly the same thing, except this hacker is not quite as sophisticated, and this hacker, in fact, isn't even hacking. This hacker simply gets a Gmail account with a name very similar to one of your executives. Maybe he's got an underscore in it somewhere, and he sends an email to that same person requesting exactly the same thing. Well, now this person has not modified your computer system. And as a result, they don't fall within the scope of the cyber policy. Do they fall within the scope of the crime policy? Maybe, but at the very least, I've reviewed several crime policies in situations like this where the exclusion that's intended to make room for cyber is far broader than the coverage that a cyber insurance policy would provide. The cyber insurance policy will say something like, we'll cover you if they get in and modify your system, while the crime policy will exclude any crime that makes use of a computer. That's less common now, but it's still an issue that needs to be carefully analyzed, because you don't want to find yourself in that gap, the gap between cyber and crime. We move to the next slide. So there's all sorts of things, obviously, that you can do to deal with that kind of social engineering problem. I'm sure that many of you have dealt with a zealous, I'm not going to say overzealous, because I think it's precisely the right level of zealotry, IT department sending you fake emails, testing you repeatedly to make sure that you don't click on bad links and thereby download malware or make other simple mistakes. So training employees is significant, but with respect to the insurance component, you need to work with a broker. You want to make sure that you're, obviously, that you're getting the best product, but also that your broker is aware of the specific coverage needs of your business. And also that your broker is aware that you need the policies to interlock in such a way that there isn't a gap. And then you need to get an attorney to review your cyber and crime policies And in fact, this isn't just true of cyber and crime policies. This is just the best immediate example in this situation. Did you get an attorney to review your insurance policies to make sure that where each makes room for the other, there isn't a gap among them, there isn't a gap between them? Now, even in social engineering cases that are covered, you are likely to run into coverage restrictions of certain kinds. The one mentioned on the slide there is sublimits, but there are other types of restriction that different insurers apply in order to limit their own risk. A sublimit is just a smaller limit, a limit less than the aggregate limit of the policy, but there are also co-insurance requirements. Sometimes an insurance company will require you to pay 25% or 50%. And then there are separate retentions sometimes where the general policy may have a retention of $15,000 or something, but a separate retention of $50,000, and you've got to pay $50,000 before you obtain or before you begin to have coverage under the policy. And those are all ways that insurers will deal with risk. It's important to note that knowing that up front helps to make sure that you know what you're self-insuring. And so keeping track of that is important, even if there's no way to avoid it. Even if that's the best policy you can buy, you've got to know it up front. Okay, and let's move to the next slide. I wanted to briefly talk about pandemic impacts on insurance, because this is obviously a thing that has altered the insurance market. It has several impacts. Obviously, it's increased potential liability in cyber cases simply because many more people are working digitally, fewer people are meeting face-to-face and signing documents in each other's presence. It increases the possibility for fraud, but it also increases potential risks in everything from commercial general liability insurance to D&O insurance to employment practices liability. People making decisions about keeping you safe, people making decisions about keeping customers safe, those kinds of claims. But the one that I really want to talk about, and move on to the next slide, is business interruption. This is the one that most of the litigation has ultimately been about. Initially, there were some, this is the archetype situation here is the government has ordered a lockdown. You can't get to work, you can't go to work, your access to your property is eliminated. Do you have business interruption coverage in your property policy? Well, at the beginning of the pandemic, there was no virus exclusion in any of these policies. Nobody had thought of it. But, and there were in fact some favorable cases for policyholders early on, although exclusively at the district court level, none of them particularly, and many of them involving rather idiosyncratic property insurance policies. The now universal holding of all of the federal courts of appeal that have looked at this question is that business interruption coverage under nearly every property policy is conditioned on the existence of some kind of physical property damage. And consequently, since the virus doesn't actually physically damage your property, and neither does a government order, there is no coverage for business interruption. And the last circuit I saw to make that decision was the Fourth Circuit in March of this year, but it joined the 5th, 2nd, 6th, 7th, 10th, 11th, 9th. At this point, you know, every circuit that has looked at it has come to that same decision. So most courts have sided with insurers, and as we move to the next slide, it's not going to get better for the policyholder on this, because even the successes that there were based in part on the lack of existence of a virus exclusion. And now that this risk is known, and now that everyone recognizes this is not the last pandemic that we're going to experience, this risk is going to be excluded in the majority of policies that you are likely to see. And that is the response of the insurance market to a risk of this kind. And so our expectation is that there wasn't much coverage before, and there's likely to be even less in the future within the scope of property policies. And with that, I will hand us over to Matt again to talk about new technology.
Yeah, obviously, there's a lot of new technologies that are going to impact our lives and change the insurance landscape. We want to focus on one that is creating a lot of exposure for some businesses now, and we think is going to, right now it's focused on Illinois. We think it's going to end up impacting folks in a lot of the states, and it's starting to result in coverage litigation already. And that's lawsuits that relate to biometric data. And so, a lot of times employers may have information from biometric screenings of employees, but the suits we're seeing are more involved with technology that's used for time entry and access, whether it be iris scans, fingerprints, face scans, voice recognition, biometric data about employees for access and time entry. And there has been an influx of suits relating to special privacy laws involving biometric information. And BIPA is the Illinois Biometric Information Privacy Act. And I'll let Dave just fill us in quickly on some of the suits that he's seen involving BIPA. But our understanding is there are a lot of states considering something similar.
Thank you, Matt. And I'll just comment as one of those lawyers that's defending biometric privacy class actions on behalf of employers and on behalf of in regards to consumer-related claims. And by now, I'm sure most of your businesses, the secret is long since out about the Illinois Biometric Privacy Act and that regarding the use of any biometric device to capture, whether it be fingerprint scanning or facial recognition, as Matt suggested, and the obligations of employers and, frankly, anybody collecting that information to have both written or have both informed consent by the provider of that biometric information as well as retention policies and public disclosure of those policies for how to store, maintain, and discard data. As Matt will tell us, the insurance landscape around the BIPA claims feels a lot to me like what John was just talking about with respect to the pandemic-related litigation on insurance. And I'll kick it back to you, Matt, to talk about the insurance landscape that we've seen for companies, both large and small, attempting to obtain coverage for BIPA-related liabilities that are statutory in nature in the form of what the Illinois statute calls liquidated damages.
Yeah, the policy or the insurers are taking a very aggressive approach against policyholders relating to these types of claims under a number of policy types that people are looking for coverage. Your general liability coverage, your CGL policy, the D&O liability, employment practices liability policies, and cyber policies. They are all being aggressive. Part of that is accelerated because in Illinois, where a lot of these are involved because of the BIPA, there is a unique provision that requires the carriers to initiate a prompt declaratory judgment action if they deny coverage. So there's been, to avoid waiver and estoppel of their coverage defenses. So there's been a handful of cases already litigating these issues. Most people have a general liability policy, and so they're looking for coverage under that. There have been 4 arguments the carriers have raised against that. It's certainly not, these kind of claims don't fall within the bodily and property damage coverage that the policy affords, but those policies do provide personal and advertising injury coverage through the enumerated offenses in the definition, and some of those involve privacy rights, but the carriers argue that it requires a publication of private information, and therefore there's not always a publication when the issues involve, proper consents and retention and so forth. With respect to that type of argument, there has been a case that has now made it up to the Illinois Supreme Court has broadly interpreted that publication requirement and found in favor of the in favor of the policyholder there. There are three main exclusions that the carriers rely on in these types of policies, which are fairly uniform, although some of these exclusions differ a little from policy to policy, and some are endorsed on the policy. One, there's an employment-related practices exclusion that appears on a lot of these policies. The idea is to work out or to take out from the coverage that which is usually covered under an EPL, an employment practices liability policy. So with respect to that exclusion, there has been one court that found it to bar coverage, a federal court, but the other four or so that have addressed it said, well, it's not broad enough, it's an exclusion, it's narrowly construed, it identifies certain types of employment-related practices, such like termination or failure to hire, or certain things related to treatment of employees, really sort of punishment for their actions, and it really doesn't fall into that category. There are exclusions that will apply to certain violation of certain statutes, but similarly, those exclusions usually identify specific statutes like the TCPA or the CAN-SPAM Act of 2003. There's sort of a tail catch-on. They'll say any like statutes like that, and the carrier will say, well, BIPA will fall within that. And the courts really have been coming down and favoring the policyholders, saying BIPA is its own animal. It's not within it's not a similar statute to these other statutes that's excluded, and so it doesn't fall within that tail. The third is access or disclosure of confidential or personal information exclusion. This one's been litigated less. It's not in all of the policies, but it's really about access or disclosure of anyone's personal, confidential, or personal information, including patents, trade secrets, processing methods, consumer lists, financial information, credit card health information, and other types of non-public information. They're going to say it's within that, but it's kind of the same thing where it laundry lists a number of specific types of stuff, and the courts that have looked at it say, well, this exclusion wasn't really designed for this purpose. Now, what I will tell you is just like how the communicable disease virus exclusions are going to appear and everything, I fully suspect that either a BIPA exclusion or a BIPA added to the violation of statute exclusion is going to start appearing in these general liability policies. There has been some litigation about coverage under the employment practices liability policies as well, and D&O liability. Usually the D&O will exclude it, and a court has found that based on, unique language in one D&O policy that may not be in others. With respect to EPL coverage, it defines a type of wrongful acts, employment acts that bring it in through the insuring agreement and cover it, and the carriers keep arguing it's not within the type of grants of coverage through the definition of wrongful acts. Kind of the reverse argument with the employment related practices exclusion in the CGL. But the courts tend to treat grants of coverage very differently than exclusionary provisions, where the grants are construed broadly and the exclusions narrowly. So courts are reaching to try to find coverage for these. Okay, we're on our second special word or secret word. The word is rain. So if you can select the correct word from the list below, and then we'll wrap up shortly. Okay, I want to touch on market conditions. We're attorneys, we're not brokers, but we have some idea what's going on in the markets. I don't know if you've come up for renewal or replacement recently. Obviously, you did whatever your last policy year was, and maybe coming up soon. But the markets have hardened significantly. It probably started in late 2009. It worsened during the pandemic. A lot of the policyholders have seen increases in premium year after year, and unlike the insurance markets are naturally cyclical, they go from soft to hard. And when I say hard, I mean there are premium increases, and there's really capacity issues with a lot of the coverage. And by capacity, I mean the carriers are unwilling to underwrite as much coverage, as much in total limits to as many people as they had in the past. They're constricting how much exposure they have out there at any time, which just drives prices up further. This is happening in the markets now. No one knows exactly when we're going to ebb back the other way, but a lot of people think that this is a particularly hard market and may last much longer than the natural ebb and flow of the market that people may be used to seeing with small swings each which way. There was a very hard market in the 80s for a variety of reasons. There's a hard market now for a number of reasons. Without detailing them all, it's really a confluence of a lot of factors. Carriers are very concerned with a concept called social inflation, which is just great or huge verdicts that they keep seeing in all kinds of different cases that are being litigated, with juries awarding a lot of monies to plaintiffs without tort reform. The pandemic certainly hasn't helped. I think in 2021, the pandemic cost insurers about $8 billion. I take that back. In 2020, based on a 2021 review, about $8 billion. They still made a profit of about $36 billion, but that was down considerably from where they were in 2019. The financial impact of both the pandemic and just with the economy has a huge influence on what the carriers are willing to do. If you think about it, the carriers make money off your money by investing premium. And so if those investment opportunities aren't there for insurers and reinsurers who are insuring insurers on the back end, it makes the market hard and difficult to find the coverage you want. There have been a greater than expected impact through natural disasters. If it's global warming or whatnot, there have been a increased frequency from what they had historically predicted and actuarially figured out, and the severity of them has been extreme too, whether it be wildfires, freezes, floods, hurricanes. And so that has set the industry sort of into a tailspin here, where it's all driven towards this hard market. No one knows exactly when it's going to end. I suspect it may be a couple years, 2 or 3 years even from now. What I do want to advise with respect to that is to start early with your broker if you're coming up for a renewal or replacement. And don't be surprised. That's why I just want to let you know what's going on out there. So don't be surprised if your premiums go up and if you have some difficulty finding coverage. Different brokers can access more markets than others, and they can probably find the coverage. It's just going to be harder than it's been in the past. With that said, I kind of wanted to move and just touch on some predictions of, where insurance issues may be going in the near future. I do think the demand is going to increase and the market will cycle back eventually to a softer market. I just think it's going to take longer than normal, the normal trend, several more years, like I said. I think you're going to see a renewed interest in some of the environmental insurance products and an ever-increasing interest in cyber products, for the very reasons we talked about, and when people start to realize that they really need that product as everyone moves to a digital environment. I could see some new products developing. There's really nothing out there right now. Business interruption is obviously a huge issue that John talked about, but there are limitations with it in your property policy, and there are issues with it in your cyber too. And everyone needs business interruption insurance. I could see a special product developing for that at some point in the future that combines some of these concepts, whether it be property, cyber, pandemic, regulatory, access, utilities, and others. I think you're going to see exclusions like the communicable disease and BIPA, and as other statutory schemes develop, the industry is going to react to restrict the coverage from those and curb their exposure. And I think we're going to see a lot more cases, whether it be BIPA. There is not a lot of developed law relating to cyber right now, but I do think that's going to continue to develop. So with all that said, we've got about 5 minutes left. If there are any questions that anyone wants to put in the Q&A, we'll be glad to answer them. If not,
well, while we're waiting for any questions that may come from the audience, I actually have a question for you, Matt, related specifically to the interplay between vendors and providers to a business. I guess my question is, when you require a vendor or provider to add your company as an additional insured and also obtain your own insurance for that potential risk, which carrier pays out first, and how does that get settled?
So that's a good question. It really depends on the language you put in your contract and how that is documented in the policies. And all the policies contain other insurance clauses. So if you have other insurance, that insurance is going to pay first. So if you design your insurance requirements to have someone add you as an additional insured, and you require it to be on a primary and non-contributory basis with your own insurance as kind of the magic language, then the other insurance clauses in the policy should track such that you would, the vendor or provider who's adding you as additional insured, that carrier should pay out first before, and your coverage will move into an excess position.
That makes good sense. We do have a question, and I think it's a good one. Why don't both of you all take a shot at this. The question is, do you think cybersecurity insurance will still be around in 10 years, considering how hard and expensive these products are to get?
I think some form of it will be around. I think it may look very different. There have been carriers who have dropped out, and we talked about reducing capacity. Obviously, it's a huge risk. There's an appetite for it among insurers right now because there's such a demand, but the prices have gone up, and it could get too expensive at some point with carriers unwilling to write the risk as everyone moves into the, kind of an all-digital sort of environment. But I think there will be some form of it around in 10 years.
I think that's probably correct. I also think it's likely that you'll start seeing some kind of siloing of different cyber risks. At the moment, cyber policies often contain a lot of different risks that require a lot of different underwriting math that isn't at all similar. And you may see cyber split up in such a way that it makes a little more sense. You may see specific breach response. You may see specific specific fraud related, that kind of stuff.
Okay, we have another question about whether we've seen a growth in use of clients forming true captive insurance companies and any attacks or narrowing of the rule for captives. Yes, we've seen more clients exploring the possibility of setting up true captives. This becomes particularly appealing when the market gets hard like this. When soft markets, people are less interested in this situation. When the markets get hard, everyone wants to jump in and all of a sudden look at a captive situation. Obviously, you could talk a lot about captives. There are all kinds of benefits other than insurance, including tax benefits associated with them. In my experience, years ago, everyone was set up captives in the islands. Now the states have all tried to be pretty open and encouraging of captives, and I don't think they're necessary. There are all kinds of requirements to set them up and set them up properly, but I view the many states as all kind of competing to get folks to set up captives based in that state under their laws, and they try to be very helpful and encouraging of that without narrowing or making it more difficult for people. So it is an option to deal with risk. It brings about all kinds of issues. I mean, you're holding your own risk there for all kinds of stuff essentially through that captive. But I definitely see a growth in interest from clients trying to form true captives.
Well, it seems like we've come to the end of our session. Matt, John, thank you very much. On behalf of the Business Litigation Group, I appreciate everybody attending. Please note our upcoming webinars. We're going to have a 2022 litigation update on May 12th by Renato Mariotti, Elizabeth Myers, and Judge Booker Shaw. We're going to have a follow-up that same day on how to end a business relationship without litigating. Christina Barish, Val Bomar, Katie Clark, and Laura Jordan. We're going to do a defending class actions on June 1st. And then we're going to have an ethics seminar regarding the corporate client privilege also on June 1st. Hopefully you can attend some or all of those, and we look forward to being able to provide good CLE content. Thank you for your participation. We would ask that you complete and submit the survey that will display for you at the conclusion of the webinar. Thank you all very much.
And feel free to reach out to any of us individually. Our information is up there if you have any other questions.